Okay, welcome everybody to the Worth and Wealth Seminar. I'm Carrie Palazzo. I work in the Office of Economic Empowerment. Today we have a great guest from Citizens Bank to talk about home buying. I'd like to introduce Sage LeBlanc to you. Sage brings nearly 20 years of experience in the home mortgage industry, including over a decade as a CRA loan officer at Citizens. She's passionate about helping individuals and families, especially first-time buyers, access resources to achieve home ownership. A Massachusetts resident and proud parent, Sage is dedicated to guiding her clients through the home buying process with expertise and care. All right, Sage, the floor is yours.
Yes, good morning, good afternoon. My apologies, everyone. So this is Homeownership 101. And to start, so as a first-time homebuyer, one of the questions you want to ask yourself is, where do I even start? A lot of you are never, you guys are not sure where to start when you are looking to purchase. So the first thing that you want to do is you want to think about your credit. So your credit score is very important. So you want to check on your credit to see where your credit is at, if you even qualified just by your credit. So we use when we determine if you qualify for mortgage, we pull 3 credit scores. So they are from Experian, TransUnion, and Equifax. Amongst the 3, we use the middle credit score. So what I mean by the middle credit score, we don't use the lowest or the highest, we use the middle. So for example, if you have one that's 700, another one that's 689, another one that's 720, we would use the middle. So the middle between the 3 that I shared with you would be 700. So we use the credit score. So that would be the number that we would use to qualify you. Now, what we're looking at on your credit is to see if you are making payments on time. We're looking for, if you're making payments on time, that's great, then your credit score will increase. If you have late payments, this is something you have to work on to make sure that you don't continue to have the late payments. Next thing you should look at is, besides your credit, is calculating how much you can afford. So let's be realistic. I know everyone wants to have a really, beautiful house, and you believe you can afford a property that maybe $4,000 a month, but in reality, you can only afford one for $2,000. So you want to look at your income. So if your income is $3,000, I'll use a different number. Let's say your income is $5,000. You want to say, okay, how much of that $5,000 am I willing to use to have a mortgage? Think about, you have other bills as well. For example, you have your car loan, you have car insurance, you have student loans maybe, and if you don't have student loans, you have credit card bills. If you don't have that, you have children maybe. You want to buy food, you have electricity, utility bills, things like that. You want to take all those into consideration. Your payment should be comfortable for you every time you're making those payments. So remember, keep in mind that those payments are for 30 years, and you really want to estimate how much you can qualify for. So calculating how much you can afford is important. So look at your budget. You can sit down with a counselor who will help you complete a budget to help you decide how much you can actually afford before shopping for a mortgage loan. Next thing you want to think about is your savings, which is really important. Now, when you're thinking about saving for your home, you want to think about saving at least 3%. Although we have programs that allow you to put down 1.5%, but you want to think about 3% savings, like 3% of the funds that you would need for your down payment. If you're interested not even interested, if you qualify for the programs will help you with the down payment. They will also help you with closing costs, but you have to qualify. But I will talk a little bit about that a little further down the line. So saving money, you should save 25 to 30% of the purchase price to cover your down payment, closing costs, and other expenses. What I mean by other expenses, it would be your home inspection, appraisal, and your homeowner's insurance. So when you find a property, you have to pay for 4 things: your down payment, your home inspection, your appraisal, and your homeowner's insurance. You have to pay for the entire year upfront for the homeowner's insurance. So all those funds will come out before you even get to the closing. The next thing you want to do is research the lenders. There are many lenders. So I'm representing for Citizens Bank, but you can use other lenders as well. So you want to research all of the lenders that you are interested in, that you think would offer you the best mortgage for you, or the best situation for your financial needs. Then you would research. Let's say you decide to research 3 people: Citizens, Bank of America, Metro Credit Union, for example. You would call us and talk to us and see what we can offer to you, and then you would move forward, whichever institution you think would be most beneficial to you. Next thing is, once you've decided, you want to think about getting pre-approved. And once you decide which institution you're going to work with, you will complete a loan application, submit the required documentations that they request. So those documentations, they tend to be, normally the 5 that I'm going to list right now for you, which is the W-2 for the past 3 years. So W-2 2023, 22, 21, and also the tax returns. If you're a W-2, if you're a wage earner, we would need the 1040 tax returns. If you're self-employed, then you would give us the 1120S tax returns, along with your personal tax returns as well. Besides that, you would need to provide us pay stubs. We require at least 1 month pay stub. If you're paid bi-weekly, it's 2. If you're paid weekly, it would be 4 pay stubs. In addition to that, we would require 3 months bank statements. So 3 months bank statements, it has to be most current, so consecutive months. So for example, we would do September, October, November, since December is not over. Once December is over, then we would require the December month as well. And then besides the bank statements, we do request any investments that you have. So for example, if you have a 401k, a retirement, an IRA, we do require a quarterly statement for that as well. Now, once you have submitted all of those documents, then we would structure a loan for you. We, meaning a loan officer like myself, we would structure a loan for you and then provide you with a pre-approval, which would state your purchase price, your down payment, and as well as the expiration date on the pre-approval. Throughout the institution, the pre-approvals, they are valid for 3 months. After 3 months, we would need to repull your credit in order to issue another pre-approval to you. Next, once you have your pre-approval, you want to speak with a realtor. Whomever you would like to work with, you would select that realtor, and then that realtor then would start to show you, probably 3 to 6 houses. It's really up to you which property you want to see. They'll send you an email, and from that email, you will select they keep walking by my office. You will select the property that you would like to view, and then they would take you to see that property. And then they'll be able to explain the process to you from that point on. Now, how do you get the best mortgage for your situation? Again, talk to your lender, see what they're offering to you, see what the rates are, if they're offering you a fixed rate, if they're offering you an ARM rate. I'll talk to you a little bit more further down as well about the ARM rates. And then again, convenience, if they're available. Some loan officers, you want to make sure that this person when you are reaching out to them, that they are reachable. So things like that you want to look for. And sometimes you just get a, I don't know, like a connection with the person. And if you do, you can work with them, and then they will help you with the process. Benefits of owning a home. There are 3 benefits of owning a home. It is tax benefits, building equity in the property, and you build credit, as well as predictable payments. So, for example, when you are renting, your payments are not, they can, they can vary from year to year. Now, when you purchase your home, your principal and interest payments always remain the same. Now, although your payments can increase based on your property taxes and your homeowner's insurance, but the principal and interest can stay the same. The only way that the property taxes will increase, only if the city increases the property. And when they increase it for the whole city, not just for you, not just for your home per se, so for everyone. So everyone would receive an increase. And if they increase it, then what happens is that they'll send the notice to the bank, and then the bank then will increase the property tax for you as well. And then you will receive a mortgage statement slightly higher, but it's not gonna change your principal and interest. Your principal and interest will be fixed for 30 years, unless you refinance for some reason, okay? Normally, people refinance only when the rates drop. And if you are thinking about, once you purchase the house, if you want to refinance, you always want to refinance if the rates drop about 1% or more. If it's less, then it's not cost effective for you to refinance. So the tax benefits you'll receive is that every time, when it's time for you to file taxes, you can use the taxes to so that you can file, so that you can gain benefits for having the home. So which is really important, versus when you're renting, there isn't, you don't get that benefit on your taxes. When you the next thing would be building equity. When you build equity for your home, one of the most significant advantages of owning is to build the equity. Equity is the difference between the market value of your home and the balance of your mortgage. So meaning that each year when your balance decreases, because you're making payments into your mortgage, then you are building more equity. At the end of your 30-year term, what will happen is that you will have gained an enormous equity, and those equities can be used even during the 30-year term. Once you have equity, you can use the equity to pay for colleges. You can use the equity to buy another property. You can use the equity to purchase a new home. So there are different, you can also use the equity to repair the home if you wanted to renovate your, I don't know, like the kitchen or even the entire house. You're able to do that as well. You can borrow off the equity to help you purchase the home. I have to say, when I say borrow the equity, doesn't mean you don't have to pay it back. You will have to pay the equity back. So think carefully when you are looking to use the equity of your home to make any purchases outside the mortgage. Those equity funds that you have used, you will need to pay them back within a period of time.
Sage, just a couple of questions in the chat.
Yes.
So one question, and I know that I know you referenced talking about the ARM later in the presentation, but someone asked, if you select an adjustable rate mortgage, your monthly mortgage payment can change if your rate change. Is this correct?
Yes, because when you select an ARM rate, you have, I think that's my next slide. Yep, that's my next slide. So I'll just move on to it. So when you select an ARM, sorry.
Oh, just 2 other questions before we talk about that.
Okay.
Somebody asked, since there's no W-2 available, what documentation is required by you when the applicant is self-employed?
Okay, so, you would need a 1099 if you don't have, if you have 1099. If you don't have 1099, we would only need your tax returns. We would need 2 years of your tax returns to determine, that you are self-employed, so that, we can calculate how much you qualify for. So when you are self-employed, what we're looking for is your profits. For example, if you claim that you have a self-employed gross income of $200,000, and then your expenses on your tax return says that you had expenses for 150, and your profit says you have a profit of $50,000. That means we would only be able to use the $50,000 as your income, because that's all you have remaining.
Great. And before we go on to the mortgage rates, just one question.
No, I'm fine.
Thank you so much. How does equity work for affordable house mortgages?
So home equity lines, they are variable. The rates are variable. The rates change from month to month. All institutions, every institution, they provide you the home equity line of credit for a term of 10 years. So what happens is that you use the home equity line. So think of a home equity line like a credit card. You use it, you put it back. And each time you use the credit card, you have to pay it back. So each time you use the home equity line, then you have to pay it back. You only let me think, hold on. So you're only making, I'm sorry, I don't do home equity lines, but I do know home equity lines. So you only make payments on what you use. So for example, if you have a home equity line for 100,000, think of a credit card like 100,000, and then you use $20,000. So you will only be obligated to make the payments towards the 20,000. The remaining of the funds, as long as it's not utilized by you, then you do not have a payment against the funds that you are not using. But the ones that you did use, which is the 20,000, you will have a payment. Now, those payments, the rates can increase, it can decrease. So it varies every single month. It's not a fixed rate. So it varies every single month. So if the rates drop, then you're fine, then your payments are low. If the rates increases, your payments can also increase. So if you have a home equity line for, let's say, 200,000, and you started with a rate of 3%, and you've used all of those funds, now the rates, I'm speaking of today. Today, the rates are higher. So your home equity line would be maybe 8%. You would have a payment of about $1,800, $1,700. This is not including your mortgage payment that you already have. So which is a payment you did not anticipate to increase so high. So now that your payment has increased, you have your mortgage payment, that's probably $2,000. You have the home equity line, that's $1,800. If you realize that your payments, you have a home equity line and your payments has increased, you need to contact a lender, 2 or 3 lenders, and see what they can offer to you, and try to refinance your mortgage along with the home equity line. Sometimes we'll let you know if it's cost savings for you, and if it's not, we'll tell you it's not, and all you can do is try to pay the home equity line down. And I know that it's not gonna be easy because the rates are higher right now.
Great, thank you. And just a clarifying question on the question is, does the equity grow on affordable mortgages in the same way that it would grow on a regular mortgage?
It does, not as much, because there's the equity on affordable mortgages. It's because, so if you have an affordable home, one of the homes that you go through the city, and they're offering it to you at a slightly different price, then yes, it will grow, but not as much as if it would grow with someone else, like another individual like myself, who went out and bought the property for the actual value that it was at that time that they purchased it. But yes, it does grow on both mortgages. It's just slightly different how it grows on the restricted deeds versus the deeds that consumers are purchasing on their own without any assistance through the city. Sorry. So for example, if you were to buy a home valued at 200, I'm sorry, not valued, but you purchased a home from from like the lottery homes from the city, and it costs you maybe 300,000, and that home is really valued for 600,000. But because you only purchased it for 300,000, the equity will not grow as much, because you got it for a lesser amount as well. So and I believe that you can only, I'm not quite sure on that, but I think they have a minimum of 10% that you can, of equity that you can make on that property. They do have guidelines on that. I can research it a little bit more for you if you need me to.
All set in the chat. Thank you, Sage.
You're welcome. Okay, so not to discuss the mortgage terms. Normally, when you apply, when you're a first-time home buyer and you visit a loan officer, our job is to place you in a mortgage that would be most protected, I always say, or comfortable. A fixed rate mortgage tend to be the best product or term, I should say, the best term for first-time home buyers. Even a person who's buying another property, like a second property, a fixed rate mortgage protects you. What it does is that it eliminates your mortgage from fluctuating up and down every single month or after a certain number of years. So always when you see us, we will place you on a fixed rate mortgage. The adjustable rate mortgage, I'm gonna talk to you a little bit about that. That is more for investors. If you're not an investor, you don't want to take advantage of the adjustable rate mortgage, and you would only take advantage of that like if the rates were really high, and then you know that within 3 to 5 years you're definitely gonna refinance. What happens with adjustable rate mortgage? So we have different terms. There is a 5-year one, a 10-year, a 15-year one, and a 20-year. So what happens is that when you, let's say for example, you have the term of 5-year rate mortgage, for the then what happens is for 5 years, your rate is fixed. Once that 5-year come to an end, now your rate will be adjusted. So, which means you go into an adjustable rate. At that point in time, the rates will vary from month to month, depending on whatever the rates are doing. So if the rates are high, then you're gonna receive that rate. But if the rates are low, then you're gonna get that lower rate and your mortgage will be lesser as well. So it does have its advantages and disadvantages, but it depends on what the rates are doing. So the adjustable rate mortgage, I normally, unless someone asks me to put them in the adjustable rate mortgage, I tend not to, but I never will we as loan officers place a first-time home buyer in an adjustable rate mortgage because it's not the best one for you. So maybe later on, if this is something that you want to do, we will discuss it with you and give you our opinion on if this is a good time for you to be in an adjustable rate mortgage. But keep in mind that during that adjustable rate mortgage, when you need to refinance, if your credit is not up to par, you won't be able to refinance. And then if that rate increases, now you're in a bind because the rate has increased, your mortgage payments are higher, your credit is not where it needs to be for you to refinance. Now you're gonna have a problem. So always better to focus on the fixed rate mortgage. Annual percentage rate is the annual percentage rate that you will be charged for the entire term of the loan. It differs from your mortgage rates. So basically, hold on, my internet is doing something. Okay, can you hear me all right, Carrie? I just got a message.
I can.
Okay.
While we have a break, I have a question, but I'm happy to wait until we finish the 6 areas.
Okay. You have a
Want to hold on
question?
the question or?
No, go ahead.
Great. When a home is owned by joint tenants, but the mortgage is only in one person's name, what happens to the loan if that person passes away?
Okay, so is the deed also in one person's name?
So the deed and the mortgage, so those don't necessarily have to be the same person. I don't know if the
No.
person who had the question wants to clarify, if they're asking,
All right,
can you
so
give both scenarios?
I'll try. I'm gonna touch base on both, okay? So if you have a property and you are on, let's say, one person is on the deed and two people are on the mortgage. So if something were to happen, then that person that's on the deed, the other person, can refinance the property. They would have to show proof, why this other person is not going to be on the mortgage, but as long as they qualify, they can remove that person. So let's say that I've had scenario where one person is on the mortgage, but not on the deed. So let's say something happened to the person that's on the deed and not the person on the mortgage. Then whoever is on the deed, now hopefully they have a, a will, something that states who will refinance the property. And then they would have to be added to the loan so that, they would have to be added to the deed so that they can refinance the property. But you can always refinance the property. So either the person on the mortgage or either the person on the deed. But the only difference is that the person on the mortgage now that's not on the deed would have to prove that they have some type of ownership to the property.
Okay.
Did that answer the question?
Yeah, the scenario was that the deed was in both names. So that if
Oh,
someone
so
held the mortgage,
yeah.
someone, and then both names were on the deed. So it sounds like you would be able to refinance if you were on the deed.
Yeah, anyone can if you're on the deed, if two people are on the deed, either parties can refinance the property. The only reason that, sorry. The only reason that one person, would not be able to refinance is if they cannot, support the mortgage. So, for example, if it took two of you because of income to purchase a property for 800,000, now you want to remove that individual, maybe a year later, you will not be able to do so because you have to qualify for that amount. So that means your income now would have to be equal to that individual's income that you are looking to remove off the mortgage. Make sense? A little bit? We're good, Carrie?
Yeah. Yep, I will follow up with the person with the question, and I can certainly follow up with an email after the presentation. Thank you, Sage.
Okay, you're welcome. Now, so there is mortgage terms appraisal. An appraisal is conducted not by us. We work with, all institutions work with outside third parties, so outside agencies to order an appraisal. Once you have an accepted offer, then you will receive your disclosures from your loan officer. After you receive your loan disclosures from your loan officer, you will e-sign the docs online. Then after that, maybe a couple of hours later, you will also receive a payment fee request. That payment fee request is for the appraisal. Once you have made the payment for the appraisal, once you've rendered the payment, then we will be notified that you've rendered the payment for the appraisal. Then we will order the appraisal through the appraisal company. We really don't know which appraiser is going to be, who's going to receive the appraisal order. But once that person receives the appraisal, then they will contact the realtor. Normally it's the seller's realtor that they contact. And then they will visit the home and make a I guess a determination what the value of the home is. Once they're done, they will send the bank the report, and then the report, once the bank receives the appraisal report, then the bank will share the appraisal value with you. Now, let's say that let's say you have a property, the appraisal comes in at 700,000. The purchase price is 700,000. The appraisal comes in at 700,000, we're good. That means that we're willing to offer you the mortgage at the 700,000. But let's say that you have an appraisal, the appraisal comes in at, so you have a purchase price of 700,000 and the appraisal comes in at 680. Now we have a difference in value. Now, once the appraisal comes in less, whether it's 5,000 or 10,000, then the bank will only finance the appraisal value. And what happens is, you can do a couple of things. You can contest the appraisal. When you contest the appraisal, you will have to send in comps. And the best way to receive those comps are from realtors, because you as a buyer don't have access to get comps. So you would have to ask the realtor to do that so that you can contest the appraisal. And then once you contest the appraisal, it takes about approximately 10 days for us to receive the report back, sometimes less, but normally it's always 10 days. But then when the appraiser return with the updated value, then you can renegotiate the price. But what I would advise you to do is that if the appraisal come in less, is not to contest it, is to renegotiate first. If they say no, then you can say, okay, I want to contest the appraisal, and only the borrower can contest the appraisal, not the realtors, not the attorney, not myself. Only the borrower has the ability to do so. Closing cost. Sorry, my internet is, so I'm just waiting. So closing costs. Closing costs are all the fees that you would incur during the transaction. So in order for you to bring to the closing, and your loan officer will always share what your closing costs, what your estimated closing cost is. She's not gonna know for sure. She or he could be a little higher or a little lower, but they should be very, very close to the previous estimation that they provided to you, unless something drastic changed with the loan. For example, if you renegotiated the purchase price, then that's when you know that there would be a drastic change in your closing cost. But other than that, it should be the same. So your closing cost would be the origination fees, the prepaids, your closing costs, your attorney fees, your buy down rates. So buy down rates are interest rates. Sometimes, especially now, a lot of consumers have been purchasing the lower rate. And when you purchase the lower rate, so you're buying the rate. So what you're doing is that you're paying for the rate to be lower. And if you are, then there's also a buy down cost to you for requesting the buy down rate. So you'll see all those fees on your closing cost that you will incur, that you will have to bring to the closing on your closing date. Okay, you should receive a loan estimate, and that loan estimate will itemize all the categories that you are being charged for. If you have any questions, you can review that with your loan officer at any point before your closing, 3 days, a week, it doesn't matter. As soon as you receive that loan estimate, it's time to have a discussion with your loan officer to make sure that you understand what you're looking at. Okay. Your escrows. I'm moving over from fixed rate because I did discuss the fixed rate mortgage, how important it is for you to always request a fixed rate mortgage because your rate doesn't change and your payments does not change. Just a quick note on that. Your escrow is your taxes and your property taxes and your homeowner's insurance. So escrow, you would need to pay at least 3 months in escrow for both your property taxes and your insurance. Now, don't forget, you still have to pay for the insurance in upfront for a full year. But even after you make that payment, you are required to pay 3 months in escrow for property taxes, 3 months in escrow for homeowner's insurance. That's because you're gonna have one payment to make every month. So every month when you make your payment, your mortgage payment, your principal is included, your interest, your homeowner's insurance, your property taxes, and your mortgage insurance. I'm stating your mortgage insurance because some people have mortgage insurance and some people, they don't have mortgage insurance. It depends on the program that you can qualify for. But if you do, you will make that one payment, and that one payment will cover everything. So the bank collects escrows it's because since we're paying the homeowner's insurance for you and your property taxes, we are asking you to make this payment every month. Now, after you close, normally 3 months later, the bank receives a payment request for the property taxes. So let's say at that time you have $3,000 there, but then your property taxes come in, they're $9,000. We pay it in full. And once we render that payment in full to the city, now we are, once you continue to make your mortgage payment on a monthly basis, then we will remove the escrow and then place that escrow into the escrow account. But at that time, the escrow may be at a negative amount, but it will replenish back each time you make your mortgage payments. So don't worry, that's how the escrow works. Home buying process. So 9 steps to buying a home. So start your journey off on the right foot by familiarizing yourself with the overall home buying process. So set your budget again. Look at your budget, decide how much of a mortgage payment you can afford alongside your other expenses. And keep in mind your other expenses could be shopping, vacation, so things like that. Because you don't want, if you purchase a home, you really don't want to stop traveling. You want to maintain the same lifestyle that you were accustomed to, because that's what you're going to continue to do regardless, even after you purchase a home. Next, determine your down payment. Talk to a lender to see what the best number is for you to put down on a home. We will always share that information with you because, again, we want to place you in a comfortable payment zone. I've touched base on this before, so I'm just going through this again. All right, let's see. Thank you. So check your credit score. Make sure your credit score and credit history are in a good place. I want to say, I just thought of this, so I want to mention it to all of you. If you have collections, please pay them off. If you're in the process of buying, do not contest, don't contest the vendor. So don't put in for a, what is it? I'm trying to think of the name, sorry. So if you have a collection, don't contest it. Don't have a counseling agency contest it for you, because you will not be able to purchase a home if you are contesting that payment, because it's already in collection. We will ask you to make the payment in full or a settlement, okay? Or you will not be able to purchase if that remains on your credit report. So just find a way to either settle the payment or make the payment in full. Because in collections, if you contest any of it during that time, you will not be able to purchase for about 2 to 3 years, depending on the program that we select for you, okay? So get pre-approved. Going shopping for a home with a pre-approved letter in hand may put you ahead of the game. Again, that's when you're sitting with us. We provide you with a pre-approval, and good luck, and hope you are able to find a home. A lot of time people are making more, they're offering more than the property's worth. Talk to your realtor again to see what the best avenue is. What you want to do is is not to exceed your qualified amount, because if you do, then the additional funds will have to come from you, and you will still be responsible to make the initial down payment agreed upon. So once you find your dream home, you will work with the real estate agent to set up tours, and also to make your accepted offer, to complete your home inspection. Once you make an offer, depending on the situation, you can match the asking price, bid lower, or even offer more. If there are several bids on the home, again, talk to your realtor to advise you what to offer on a property. Just remember, stick to your purchase and sales. Do not exceed that amount that you qualify for, because anything over that qualified amount, you will have to render those payments yourself. Order a home inspection. Qualified professional home inspectors will evaluate your home to share with you if your property is in a good condition, if there is any mold, if there's any issues, they will share that with you. The realtors will help you with the home inspectors company, they should provide you with at least three, and amongst those three, you select the ones that you would like to work with. Once you now apply for a mortgage, once you have your accepted offer, you will forward the accepted offer to your lender, along with your initial deposit. And then your loan will become live because now you have an address. That's when your loan starts. Your loan starts with your lender when you have an accepted offer. Okay. Then once you have the accepted offer, the disclosures are then structured for you, and then we, either myself or my assistant, will send them to you to e-sign and return them back to us. Once you e-sign, you can just submit. Everything's done through email and the internet, so you don't really have to sign for it manually. I want to share that a lot of I believe all the lenders comply with this. Once we send you the initial disclosures, 3 days later, you will receive a live packet in your home. That packet is for you to keep for your records. So you have a couple of options. You can keep it, or you can sign that one versus the one that's provided to you online and return it to us. Okay, so you have that option as well. Close on your new home. Sorry, I'm watching the time as well. Sorry. Right before the closing, you want to take a walkthrough, and the walkthrough is to make sure that everything you had requested is complete. So if you wanted any debris removed, hopefully they did that. If you want to make sure that the oven that you saw is there. If the fridge was part of the deal, we want to make sure that the fridge is there. You want to make sure that the property is exactly the way that you had anticipated it to be. If they had any work that they needed to do, you want to make sure that work is done before you sign those papers, because once you sign those papers, that property is yours, and any issues that occur after that, they're also yours. So I've just had a client close a few weeks ago, and their boiler went. So be very, very cautious on that. Make sure you do your home inspection. Do not waive the home inspection. I know a lot of times now people, I've been waiving them. You can do home inspection for informational only, just so you'll know what you're getting yourself into. But I'm not going to advise you to do that. I'm going to advise you to do a home inspection so that you will have the ability to renegotiate after the home inspection. Once your home inspection is done, you can renegotiate. Okay, so say for down payment, there are benefits to putting down 20% of a home's purchase price up front, but you don't have to. The average first-time home buyer typically puts down 6%, but many mortgage program only requires 3% down payment. So we do have some conventional programs that offers 3% down payment. You can put 3% or more, but we have these programs in place right now. They are I'm not even sure if I can say this, but they are through the city of Boston, and they allow you to put down 1.5% of the down payment. So for example, if you were buying a home for $400,000, the down payment on a 3% would be $12,200. Let's say $12,000. But in this program, your down payment would be $6,100. Okay. That would be your down payment. The program also offers no PMI, so no private mortgage insurance for the life of the loan, which is really great. And then the program also offers low interest rate. So low interest rate, meaning that if you're purchasing in Boston, today's rate for that program, you have to reside in Boston. If you reside in Boston, you're purchasing in Boston, that rate for the Boston area today is 4.50. Keep in mind, rates changes on a daily basis, and they are not guaranteed unless you rate lock, meaning that when you have a property, discuss with your lender, say, what is the rate today? Should I lock? What do you anticipate? Things like that. So you want to look into that. So if you do have a property, you like the rate, you like the payment, rate lock. Okay, unless you know for a fact that the rate is going down. Because once the rate, if you didn't take advantage of that rate that particular day, and the next day the rate increases, the loan officer cannot go back. They can't revert the situation and then give you that previous rate that they shared with you, because you did not advise them to rate lock for you. Okay, So with this program, again, you have 1.5% down payment, low interest rate, and no PMI for the life of the loan. Also, there are grants available. You're also able to take up to it's up to 5% grant funds available if you qualify. If you qualify, it is based on household income. For example, I'll give you a household income. One person purchasing in Boston, Suffolk, let's say Suffolk County, the max income, household income is for one person is 114. Okay, that means if you make over 114, 250, you don't qualify. But children also count as part of that household income. Your parents, if they live with you, also count as part of that household income. To make sure you qualify, you want to check with your lender to see if they have some of those programs that will help you. Okay. So I have so many grants, so definitely contact us. Ask me if you have questions as well. The Home Ready program, so Citizens does have its own programs as well. Home Ready program, this is one program that's everywhere. It depends, everybody has it a little bit different, but it's 620 is the credit score for that program, as low as 3%. This program does carry PMI. PMI is also private mortgage insurance. Destination Home Mortgage, that's in one of our other programs. That program is also 3% down. You can do for 1, 2, or 3 units with that as well. Now, that program has no monthly private mortgage insurance, PMI. PMI premiums are they are mortgage premiums that the lender enforces for the mortgage that they are providing to you. I know, unfair, but that's the guideline. So if you want to avoid PMI, you either have to be in one of those programs that I just shared with you, the Destination Home Mortgage or the previous one through the city of Boston, so that you can have no PMI. Any other program is going to have PMI unless you put down 20%. That's the other way to avoid mortgage premiums. Now, I want to share with you, if you're in let's say you have a loan that has a PMI, you can remove the PMI if you have enough equity in your home. If you've owned the home for a while, for 3 years, for 4 years, please check with a lender and see if you can remove your PMI. Most likely you can remove your PMI. You do not have to stay with the PMI for the entire time, which is normally, it begins to fall off after, I believe, 10th or the 11th year. So you don't have to stay that long with the PMI. Just check with the lender and then see if you can remove your PMI, okay?
Sage, just a couple quick questions.
Yes.
Okay, let's see. Any history or info on why the buyer has to pay for the appraisal?
Oh, yes, it's because the property is for you. So what happens is that, let's say that you're purchasing properties and you're just making offers, and then let's say the bank was paying for the appraisal. Now you've decided you're not gonna purchase this property anymore, right? Now the bank is the one that has taken the loss.
Great.
So yes, it is, because it's your responsibility, it is your property, you're the one who's responsible to make the payment for the appraisal. Anytime an appraisal is done, it is done for the owner or the buyer of the property.
Great. Couple more. Can the bank redo the rate after it's locked if you haven't closed yet?
The answer to that would be yes. But what happens is once your rate is locked, if you decide you want a different rate, they would have to unlock the rate, and you're not able to rate lock for 30 days. After that 30-day period, then you will be able to take advantage of that rate. Mind you, in 30 days, we have no guarantee where the rates will be. So the rates could be exactly where you anticipate, or it could be higher. So there's a negative side and a positive side to this. We don't know. I never advise consumers to remove the rate lock. It doesn't mean that I haven't done it once or twice before, but that's not something that I would advise you to do. If you rate lock, your rate lock is good for 30 days. And so if the rates were to increase, let's say let's say the rates increase the following day, you're gonna be happy that your rate locked. But if the rates decrease, that's when a little sadness come into play. But at least you're covered in case the rates increase.
Gotcha. If you're buying a second property, is it still suggested that you put 20% down?
So it depends. If your first property is a multi-unit, then you're able to buy another property if you qualify, a single family, not just any other property. So if you own a 2 or 3 family, if you purchase a single or condo family, a single or condo, then you do not have to put 20%. Your down payment can be 3 to 5% as long as your numbers work. The loan officer will let you know if the numbers work. But if you own a multi-unit and you want to buy another multi-unit, then it's 20 to 25% down. And if you already own a single family and you want to buy any other property after that, so if your first property was a single home, then any other property you buy, whether it is a condo or a 2-family or a 3-family, you will be required to put down 20 to 25%. I always say 20 to 25% because we don't know where your debt to income ratio is going to place you. And I want to make sure that you're prepared just in case you need the 25% because your numbers have to work amongst the DTI that is required by the program.
Great, and I'm just watching time as well. There is one more question, but I'm going to see if we can get through some of the slides, and then there is a question about PMI, but I will get back to that one.
Okay, thank you. So again, I did discuss how to prepare for buying a home, which is to check your credit score. So Experian, Equifax, and TransUnion. You can reach out to some local agencies if you don't want to reach out to a lender at first, just so that they can pull your credit and see how you look. Okay, Carrie can also help you with that as well. Right, Carrie?
I'm becoming an expert in this hour. Yeah.
So again, we discussed how to prepare to buy a homes. Some of these slides are probably a little bit redundant, but that's fine. So 30-year mortgage loan rate, and this is the 3% down. So this is your 3% rate. Of course, the rates are not there anymore right now. So this is an older version. Your APR will be 3.95, which is the entire time of your 30-year fixed rate mortgage. And then the points up. So points, sometimes you have points, sometimes you don't have points. It depends on the lender. So it really depends. The points are what they charge you to complete the loan for you. But your monthly estimated payment would be $1,264 on a 30-year fixed rate mortgage. How to prepare for buying a home, research your potential neighborhood. This is a link. I can send that to Carrie to share with all of you, so you can check to see your mortgage payment there as well. And because that particular link, you can't access it, but I can send it to you, Carrie, so you can share with the group for me, okay? But you can do that online too as well. You can actually go online. Seriously, you can go to Google and put in numbers, say mortgage calculator. Seriously, go to mortgage calculator and then put in numbers and see how much. And let's be realistic, please. If you're going to use the rate, use 6.50 rate. Do not use a 4% rate because that's not where the rate is right now. So realistically, this is where the rates are at right now, 6.50, 6.75. But when you're in the programs, remember I said that I mentioned 4.50. That's because you're in a different program. There's another program as well as 6.375. As the rates drop, so does these rates for these programs. When should you refinance? You should refinance. I did touch base on that as well. When you've built a little bit of equity. So you normally within 2 to 3 years, you should be ready to refinance, unless you had a 7% or 6% rate, and you've noticed the rate has dropped by 1 point or more. If it has, you want to contact a lender and see if it's beneficial for you to refinance at that time. How Citizens can help you. You can go to www.citizensbank.com learning, take a picture of this page, you guys, if you guys want, and contact us, contact a branch, contact me. You can contact other lenders as well. I want to just let you know that I'm not the only lender that's offering some of these programs. The only program that we're offering is the Destination Home Mortgage. Oh, and by the way, I forgot to tell you guys, we have a grant for that. It's $10,000, okay? So anyone who qualifies for that program, it has no PMI, and it's $10,000 grant that you do not have to repay back. And all these grants that we offer, you do not have to pay them back, not within 3 years or 5 years, anything, okay? They're actual grants to you. And there are grants leading you up to, I have to say that you can receive grants up to $70,000 to $100,000. It depends on your purchase price. So think of 5% of the purchase price and other grants that are available as well. So meaning that we can collaborate various grants to get you to those numbers, okay? And my contact information is right there. I also do new construction, as you can see. That's why it says new construction certified. So for me, and my phone number is there, my fax number. So email me with questions. I'm fine with that as well. Okay. Any questions? So we have come to an end, and I want to thank you all. Hopefully I was able to answer any of your questions or most of your questions, I hope. Please feel free again to contact me, or we're going to have another 5 to 10 minutes here. If you guys need me, I'm here to answer questions as well.
Great. I just want to go backwards. We had a quick question about PMI.
Mhm.
Is PMI related to the amount of equity in the home?
No, it's just so private mortgage insurance is obtained when you first have a loan because you're not putting down 20%. Remember, some programs have it and some programs don't. You can avoid it on some of the City of Boston programs, and even the Destination Home Mortgage that we offer. But no, it is based on the price of the property. The mortgage.
Great.
So I'm sorry, not the price, but the mortgage, not the value, but the mortgage that you actually have on the property.
Okay, and we have 2 people who asked the same question. So the grants that you referenced, Sage, are the grants also available for multifamily FHA homes?
They could be if you're purchasing in Boston. So if you are purchasing in Boston, then yes, they are. So you will receive up to 5% for those grants. I've had people who have $70,000. I have people who got 80, 60, 40, 30. So it really depends on the person. No. So every individual, every individual meeting with me has different scenarios. So basically you can have 30,000 and your sister can have 80,000. It really depends on each person.
Excellent. Okay. All right. While we're just seeing if then, yes, just a reminder, we are going to be sharing the slides and the recording of the presentation, as well as some resources that Sage referenced and that we'll put in as well. Sage, I just want to share my screen real quick before we end today.
That's fine.
Awesome. Thank you so much. And yes, absolutely. We'll be
And
sharing
stop
these.
sharing.
That was really helpful.
Thank
There was a
you.
lot for a little lunch break. A
I
lot of
know,
great
sorry guys.
info.
I tried to
I'm
cover a lot. There's a lot to cover. There's probably so much more that I didn't cover, but I hope I was able to touch base on some important issues
Yeah,
or
yeah, I thought
concerns.
I learned a lot. And
Thank
I'm
you.
excited to see the engagement, because that tells me that people are, really thinking about this, and this information is valuable. So I'm really happy we were able to spend this time together today. Sage, thank you so much. I just want to share some quick info.
Okay.
So a lot of information that we shared today, part of Worth and Wealth is that we have these financial education workshops and seminars. And then there's an additional piece that everybody has the opportunity to sign up for a complimentary financial coaching session with Oriana Felkowski. She's a certified financial coach. This will also be in the email. So if the QR code isn't something you can access right now, do not worry. If you registered for this workshop, you will have this information in an email. Next week, we're going to talk about investing, so more wealth building. That's next week. Registration is here. Also will be in the email. And we have a free financial education digital platform. anyone, any resident in Massachusetts has access to it and can create a sign-in. Some of the tools that Sage mentioned in terms of mortgage calculators, budget calculators, webinars, information, it's another way for everyone to access some of this information. So please sign up. And then lastly, when you leave, for those who've already left, you know this, but as you leave the webinar today, a survey is going to pop up. If you have an additional minute, 45 seconds, if you can fill that out, that information is really helpful. Sage, I really enjoyed this conversation today. It was such a pleasure to have you and for you to share clearly a very, very robust sense of information about mortgages. So good luck to everybody in your search for homes. And Sage, thank you so much.
You're welcome. Good luck, everyone. Thank you, Carrie. I look forward to doing this again, okay?
Absolutely. Absolutely. Thank you very much.